Hey everybody, and welcome back to the channel. Today we're tackling one of the biggest questions I get from real estate investors. Should I pay off my rental property mortgage early? It's one of those things that feels like it should have a simple yes or no answer, but the truth is, it depends. And by the end of this video, you'll know exactly what it depends on for you. We're going to break down the math, the psychology, and the strategy. So let's dive in. All right, here's the million-dollar question. Literally, this decision is one of the most significant strategic choices you'll need to make as an investor. It all comes down to a simple tug of war. On one side, you're being presented with a certain risk-free return. On the other side, the potential for even greater wealth in other investments. It's a battle between security and growth, and where you land says a lot about your goals. So let's define this central conflict. On one side, you have the guaranteed return. Paying down your mortgage gives you a risk-free return that's exactly equal to the interest rate that you no longer pay. It's a sure thing. No market volatility, no drama. And on the other hand, you have opportunity cost. That is the money you could be making if you were to utilize the same amount of money and get it working elsewhere, possibly in the stock market or even as a down payment on another investment property. That may carry the potential for a higher return, but also risk. Now, here's the significant detail that the majority of individuals miss. You cannot merely compare your mortgage interest rate with the stock market return. You have to take into account the after-tax cost of debt. Because the interest you pay on a rental property is tax deductible, the effective cost of your debt is less than the number on your statement. Thus, the certain return on paying it off is also lower. This is where the entire decision starts. This conflict gives rise to two entirely different philosophies. First, you've got the maximum leverage strategy. This is the go big or go home approach. It's all about using other people's money, the bank's money, to become as rich as possible. You keep your capital fluid to be able to jump on new opportunities. You achieve appreciation on the entire property value, not just your down payment, and you actually leverage your return on equity, or ROE. It's a growth engine. Then you've got the total debt-free strategy. This is the sleep like a baby approach. It's all about stability and predictable cash flow. By eliminating debt, you're protecting yourself from economic slumps. You're eliminating financial stress to a great degree, and it's an ideal retirement plan setup. It doesn't emphasize becoming super rich. It emphasizes being safe. And now the key insight. You don't have to pick one philosophy and stick with it for your entire life. The best approach actually changes as you go through different stages of your life. If you are a younger investor with a long time horizon, you are probably better off with the leverage strategy. You have time to ride out market volatility and let compound growth work in your favor. But when you're nearing retirement, the game is different. You're not concerned with long-term growth maximization anymore. You're concerned with short-term stability. You're now choosing to pay off properties to create that predictable, consistent, mortgage-free income. So this isn't a long-term decision. It's a strategic change based on where you are in your life. All right, let's do the nitty-gritty math, and I assure you it's easy. We have to figure out your actual guaranteed return, which is the after-tax cost of debt. First, the tax shield. You see, the interest you pay on your rental mortgage is tax deductible against your rental income. This lowers your taxable income, which means you save money on your tax bill. It's a shield. Now, insert the formula. Your after-tax cost of debt is your pre-tax interest rate times, in parentheses, 1 minus your marginal tax rate. Let's do an example. If your mortgage rate is 6% and you are in the 35% tax bracket, you would do 6% times 1 minus 0.35. That's 6% times 0.65, or 3.9%. That 3.9% is your risk-free, guaranteed return on paying off the mortgage. So there's your decision rule. If you don't think you can reasonably expect to get an after-tax return higher than that 3.9% on other investments, then paying off the mortgage is indeed the better mathematical option. Now let's look at a measure called cash-on-cash return, or COCR, which is your cash flow divided by the cash you've invested. And this reveals something rather surprising. Let's look at this table. On the left, a leveraged property. Maybe you have $2 million invested. It's generating $400,000 in net operating income. But after a $200,000 debt service, your cash flow is $200,000. That's a 10% cash-on-cash return. Not bad. Now look at the building that is free of debt. To own it outright, you have $6 million invested. It still brings in the same $400,000 in income, but because there is no mortgage, your cash flow is the full $400,000. Your COCR is only 6.7%. Do you recognize the paradox? The leveraged property is producing a higher percentage return. It's more efficient with your money. But the debt-free property is throwing off double the actual cash flow. So high COCR is an indication that you're using leverage efficiently. But a lower COCR from a paid-off property can mean much higher absolute cash flow, which is exactly what you'll want in retirement. So to recap that last point, a high cash-on-cash return is a sign of efficient leverage. You're making great money on the cash that you actually invested. But reduced cash-on-cash return on a debt-free structure? That's a sign of more stable, absolute cash flow. It is not worse, it is just different, and for an income needer, it is preferable. Another metric to consider is the equity multiple. It's a simple method to examine your total return on the whole ownership period of the property. You take all the cash you received from the property and divide it by all the cash you invested in it. An equity multiple of 2.5x is where you got $2.50 back for every dollar you put in. The leverage strategy is designed to maximize this number. Why? Because with the use of debt, you are controlling a massive asset and getting all of the appreciation of that whole property value, astronomically multiplying your returns on the actual money you put down. Let's suppose that leverage power. You put down 20% down payment. But when the property appreciates in value, you keep 100% of that appreciation. This gives you a 5x multiplier to your return on equity. It's the ultimate basis of getting rich quick with real estate. And by not paying off the mortgage, you keep your capital liquid, free to go invest in another property or in stocks or ETFs. Which leads us to the opportunity cost argument. Let's look at some figures. Historically, the S&P 500 has returned about 10% per year on average. Average home appreciation would be somewhere between 4 to 8%. That spread, that rough 6%, is your risk premium. It's what you're getting paid to take on the volatility of the stock market. So, if you're lucky enough to have locked in a low mortgage rate, say for instance, below 4%, the math is screaming at you to keep it. That spread between your low-cost debt and the potential market return is huge. It's akin to leaving tons of compounded growth on the table to use your money to pay off a 4% loan instead of investing it to potentially earn 10%. And let's not overlook the tax benefits. The mortgage interest on your rental property is deducted on Schedule E as a business expense. This is much more potent than the mortgage deduction on your own home. It's exempt from SALT restrictions and the $750,000 loan limit. This, combined with depreciation, generally creates paper losses that will shield your earnings from tax. It's a great tax shelter. By paying off the mortgage, you remove this deduction. You're giving up a valuable shield. Now let's shift gears and talk about the liberty of being debt-free. The biggest advantage is risk reduction. You are eliminating your highest fixed expense. This greatly lessens your financial anxiety. It cushions you from the economy. If we fall into a recession and you have a vacancy, no problem. You don't have this massive mortgage payment to worry about. You've got guaranteed positive cash flow if the rent is covering taxes and insurance. It provides you with long-term stability, no matter what the market does. And there is the psychology that cannot be ignored. Peace of mind has value. In behavioral finance, sleeping better at night is an actual return on your investment. For most investors, that emotional reward of being totally debt-free trumps the possibility of earning a bit more in the stock market. Giving up some marginal growth for absolute certainty is a rational and reasonable decision. This is the most powerful slide for anyone looking to retire. The debt-free strategy indirectly maximizes your cash flow available. Let us understand. Pre-payoff, Maybe your property is making $400,000 in net income, but after a $200,000 mortgage payment, you only get $200,000 in cash flow. After payoff, your net income remains $400,000, but your mortgage is zero. Your cash flow just doubled to $400,000. You've converted your property to a secure, high-purity, passive income stream. This is the retirement gold ticket, since it doesn't rely on the unpredictable stock market. Okay, practical warning time, the prepayment penalty trap. Some lenders charge you a fee if you pay off your loan early to compensate for lost interest. It might be standard in commercial or rental loans. It might be a percentage of your balance, like 2%, or maybe a fee equal to a few months of interest. It usually uses a step-down schedule, like 5, 4, 3, 2, 1, where the penalty reduces each year. So a key strategy here is, look at your loan documents now. If you're subject to a penalty, it's worth timing your payoff to exactly hit the day when that penalty drops to zero. Don't end up paying a huge fee that nullifies your interest savings. Here's another enormous trade-off. When you're paying down a mortgage, you're taking liquid capital, cash that you can use for anything, and converting it into locked equity, which is trapped in the brick and mortar. Once it's in the property, you can't just get it back out without getting a HELOC or doing a cash-out refinance, which means you're just going right back into debt. So you lose a lot of financial flexibility. You might miss a great deal because all your money is tied up in one paid-off property. But what if you're torn? Good news, you don't need to go all or nothing. Enter the hybrid approach, incremental principal reduction. Instead of one big giant lump sum, you just pay more principal on your mortgage monthly. This has a dual benefit. One, you'll save a ton of money in interest and shorten your loan term, which gets you that much nearer to that debt-free goal. And two, you'll retain your liquidity and diversification because you haven't locked all your funds up at once. It's a consistent middle path. All right, so how do you make this decision? Here is a matrix to serve as your roadmap. If you have a high interest rate, are near retirement, have a low risk tolerance, view low alternative returns, have no prepayment penalty, and are in a low tax bracket, then early payoff is highly desirable. On the other hand, if you have a low interest rate, you are young with a long horizon, you have a high risk tolerance, you see high alternative returns like the stock market, you have a high prepayment penalty, and you are in a high tax bracket, then you probably should keep that mortgage and leverage up. So here's your homework, your actionable steps. First, calculate your after-tax cost of debt. That's your hurdle rate. Second, evaluate your time horizon and objectives. Be realistic with yourself regarding where you are in life. Third, look for prepayment penalties immediately. Don't be caught off guard. And fourth, if you're unsure, attempt the hybrid approach. Start making additional payments. It's a great way to get your feet wet. So, to recap it all, your entire decision is dictated by one magic number, your after-tax cost of debt. Unless you anticipate consistently outperforming that figure with other investments, mortgage repayment is the mathematically superior, risk-free choice. To maximize wealth and grow your portfolio, hold low-interest debt to stay efficient and take advantage of those tax deductions. For retirement comfort and stress reduction, pay off debt to create that guaranteed, predictable income. Remember, this is not a final exam. This is a strategic shift. What's the appropriate strategy for you today might be different in 5 or 10 years. If you like this video and wish to proceed with your real estate learning, then subscribe to the channel and hit the bell so that you can know what's in store next. To keep your momentum rolling, I've chosen another video for you that will help you in your investing journey. You'll see it right here on the screen. Just click it and go ahead and learn some more. Thanks for watching. I'll see you in the next one.